Smart money is aggressively accumulating one specific currency this week, while systematically dumping another. My strongest currency is the Australian dollar. My weakest remains the British pound. And that creates one high-probability setup almost everyone is missing: shorting GBPAUD directly into deep weekly discount arrays. Current positioning tells us institutions are hunting massive sell-side liquidity resting right below recent structural lows. So what does this all mean for us? The outcome we are stalking is a high-conviction short on GBPAUD. We are leveraging the immense weakness of the pound against the massive structural strength of the Aussie. The absolute magnetic draw? That juicy weekly sell-side liquidity. Section 1, Smart Money Footprints. Let's completely reverse engineer the exact institutional footprints that set up this massive trap. Ranking the board from strongest to weakest gives us the institutional playbook. The New Zealand dollar is seeing aggressive accumulation on every single dip. The Australian dollar is perfectly aligned for structural lower pricing across its crosses. The euro is showing highly selective accumulation by smart money. The British pound, however, is trapped in a severe systematic liquidation program. The Swiss franc is just locked into defensive positioning. The Canadian dollar is suffering from massive structural divergence as institutions drive it lower. The US dollar is merely mitigating premium arrays right now, and the Japanese yen, it's just being used to defend range boundaries. But here's what most traders are missing. The COT report tells a completely different story than retail sentiment. Smart money is heavily distributing the pound, aggressively liquidating longs and stacking short inventory. Contrast that with the Aussie and CAD, where positioning is strictly aligned for lower pricing across cross-asset derivatives. It's a massive transfer of wealth from weak-handed retail buyers directly into institutional short blocks. Section 2, Macro Liquidity Engineering. Now, watch how they use the news to weaponize liquidity. Tuesday's CPI and Wednesday's FOMC are not just textbook news events. They are highly predictable liquidity engineering windows. Algorithms will use Tuesday's CPI to trigger a Judas swing, sweeping buy stops right out of the market. Wednesday's FOMC then creates massive premium and discount repricing, effectively wiping the board clean of internal liquidity before the real structural expansion begins. And Thursday's AUD employment data, that just provides the order flow continuation for the week's true directional bias. Section 3, Algorithmic Price Action Map. The chart and positioning are finally aligning. Let's map this macro flow directly onto GBPAUD. On the weekly time frame, you can literally see the macro shift happening. Notice how price tapped right into a massive premium structural array, a pristine bearish order block. This is the definitive shift from buy programs to sell programs. The algorithm is now drawing price downward, acting like a giant magnet for that clean discount order block and the unmitigated fair value gaps resting deep in discount territory. Dropping into the daily chart, we uncover the anatomy of the trap. This is a complex distribution phase, engineered explicitly to sweep short-term buy-side liquidity just before the floor falls out. You can clearly see the market structure shift. Large participants are capping premium prices, quietly building short inventory while inducing retail to chase a completely false upside breakout. Now looking at the H4 timeframe, we see exactly where price is being drawn. Look at those heavy pockets of sell-side liquidity resting directly below clean relative equal lows. This is the primary draw on liquidity. Retail looks at this and sees strong support to buy from. Institutions look at it and see a massive pool of sell stops just waiting to be liquidated. And down on the H1, our execution matrix becomes crystal clear. We're stalking precise retracements into premium fair value gaps left behind by recent high-velocity displacement. Every time price pushes up into these inefficiencies, institutional sell programs immediately cap it to protect the higher time frame narrative. Section 4, the retail trap. This is where smart money may be creating a trap that will crush the uninformed. The only question you need to ask yourself right now is, where is smart money engineering the Judas swing trap this week? Because before price can expand lower to our weekly targets, the algorithms absolutely must induce early sellers and trap breakout buyers on the wrong side of the market. This is the exact sequence smart money is waiting for. Step 1, pre-CPI on Tuesday, the range artificially compresses to trap breakout algorithms. Step 2, the CPI data hits, triggering a violent Judas swing higher, spiking right into a premium bearish fair value gap to run buy stops. Step 3, post-event, we get that high-velocity displacement lower, locking in the trapped retail liquidity and initiating the true structural delivery down to discount. Section 5, Execution Playbook. Let's lock in the parameters so you don't become part of their liquidity. We are focused exclusively on GBPAUD. The bias is an institutional short, playing for that premium to discount repricing. We only execute after a confirmed liquidity sweep into an H1 or H4 bearish fair value gap, ideally post-Judas swing during the London or New York kill zones. We'll take heavy partials at the H4 relative equal lows, slashing risk by 50%, and then let the runner bleed down to the ultimate draw, the deep weekly discount fair value gap, and that massive sell-side liquidity pool.
This entire bearish thesis is strictly invalidated if we see a clean daily body close with high displacement above the premium weekly swing high.
Remember, liquidity leaves footprints before price leaves trends. Wait for the algorithmic sweep, trust the higher timeframe structure, and trade the institutional vector. The trap is set, so are you tracking the smart money or providing their liquidity?